get some analysis and perspective on the Fed minutes and really what they mean for both the state of the economy and the financial markets. For that, let's bring in Jeremy Siegel, professor of finance at the Wharton School, University of Pennsylvania. He comes to us from Philadelphia. Professor Siegel, good to have you back with Matt and me. So we did get those minutes from the Fed. Anything that kind of caught your attention here?
No, and I think you summarized it very well. There's only one dissent, Tom Honig. The others are going along with the extended period. The FOMC said we have the right to change it at any time if we see either the economy veering off in one direction or the other. They want to, ensure that everyone knows that they are flexible. But it was pretty much a stand pat, which is what I think the markets expected and wanted, and why we're getting a nice rally off of it.
Hey, Jeremy, last month the Fed said that the recovery is likely to be moderate for some time. Do you disagree with that? Do you see a more robust recovery here?
I do. I do think that, for quite a while, I thought we are going to go faster on a recovery than most forecasters expect. GDP this first quarter that we just ended looks like it might be about 3%, but now I see forecasters looking at 4 to 5% for the quarter that we just started. And there's been some really strong news just recently, and I think that will mark more of what 2010 looks like than many had expected.
It seems like this is what investors would want. You think the economy is going to recover more robustly than the Fed, so they leave rates low, and it gives you a chance to cash in on some gains here. But in the medium term even, wouldn't that bring a scary inflation level?
Well, and the question, one thing I don't like, and I haven't liked I don't like oil going towards $90 a barrel, and commodities are rising. But then when you look at labor, when you look at core inflation measures, they are not up at all. In fact, we had the first decline in hourly wages in 20 years in the last employment report. That's pretty shocking. So there's no inflation on the labor side. There's no inflation on the rental side, on the housing side. Commodities is the only potential source of that inflation, and it doesn't seem to be enough to tip the scales in a direction of tightening as of yet. But look at the long bond. We crossed 4% yesterday.
Right.
We're going to, at 4.5. I don't think at 4, but 4.5. The Fed's going to look around and said, "Can I keep the Fed funds rate at 1/4 when the 10-year bond is at 4.5?" Because I think that would be an all-time record spread, and I think you'll begin to see some very serious thoughts about moving up the funds rate at that time.
All right. So how soon could that happen in your view, Professor Siegel?
Well, again, I think it might happen by the end of this summer, that we may actually see the target go up. The first stage for the Fed is they've got to raise that discount rate all the way to 1 point above the fund's target. They already did that in February once. They've got a couple more notches to go to do that. The next stage is to start raising the funds rate along with the interest rate that they pay on reserves. And I think that could come really at the end of the summer, early fall, if the recovery is as strong as I expect.
Does that then put a stop to the gains that we've seen in the equity markets, in your view, when we start to see those rates tick higher?
Historically, equity prices just pause briefly when the Fed starts increasing rates. They tend to shrug it off until those rates really get painful, and they're not going to be painful, anywhere up, I think, to 2%, certainly. And so, yeah, there'll be a little flutters in equity, but the bull markets have traditionally moved past the initial tightening of the Federal Reserve.
Have we still got another 10% to go from here, Jeremy?
Yeah, I think so. I think 10 or 15%. In fact, if things get better as I expect, we might actually get a bit of an overreaction on the upside, and then a period of consolidation. But we're going to take a look at first quarter earnings, in a week or two. We had 2 blowout quarters of earnings in the last few, so we're going to have to look at these. But I think with the news coming in strong, I think this momentum is going to build.